Well, if you go over the last month, you can see some reasonably good gains coming through in the pound as some of the political risk comes out of the currency. But certainly the Australian dollar for me has been the star of the show in the G10 currency block. You know, if you look at really what's been driving this, firstly, it's the very, very low implied volatility in financial markets, which has really promoted the Australian dollar in the carry trade format. People have been wanting to be long or own the currencies with the highest yield, and that's really the Australian dollar and the Kiwi dollar. So it's been very, very attractive to be in that currency in this very low implied volatility environment we've been seeing. But the Australian economy is improving. There's no doubt about that the RBA see inflation as troughing and potentially improving going forward. We saw business conditions coming out at the highest level since 2007, and probably more thematic of an economy that should be seeing rate hikes as opposed to potential rate cuts coming through. Business confidence is improving. You've seen Westpac consumer confidence improving to just over 2% in the month of February. If you look at iron ore, our key terms of trade, obviously that's been improving very, very significantly. If you look at it in Aussie dollar terms, since the beginning of 2016, it's now up 127%, and that led us to the biggest monthly trade surplus we've ever had in December, and that probably will continue improving going forward there as well, and that should lead us to a full-blown current account surplus at some stage this year as well. And certainly the RBA have acknowledged these factors. They're very optimistic about the future. They've certainly seemed quite positive about the outlook, and that compares to a lot of other central banks out there as well. So from a relative perspective, the Australian dollar and the Australian economy actually looks okay, certainly compared to Europe, where there's still a lot of political risk, Japan, where we know that they've got very, very unconventional monetary policy coming through, and the yen in times of low volatility will be the funding currency for the carry trade. Now, if we actually look at what's happening in the currency markets, if you look at Australian dollar against the greenback, we traded in really a range of 77 cents to 76.06 from the 2nd of February. We've broken out to the top side there, so it looks like we might head up into that 77.80 range, which is the highest that we saw back in November. The currency which I've favoured, currency pairs I've favoured, has been the Aussie yen, which is now broken out the highest level since December 2015, and also short euro against the Australian dollar, and that's done very nicely, those two trades. But the thing is with Euro Aussie right now is it's so oversold. If you look at the 9-day RSI, that's trading at 12, which is actually the lowest since 2005. So for me, from a risk reward perspective, I don't know how much more downside there's left in there. I'd be looking to sell rallies in that pair myself. But the Australian dollar, as long as iron ore and steel and coking coal stay fairly firm, and we see low volatility in these markets at a time where the Australian economy is looking relatively okay, we should see these are perfect appreciation grounds for further upside there.